Let's take a quick look at a policy that we could use for our business. So I've got 3 different policies pulled up here, and they're all on a 40-year-old, and we're going to be depositing in $100,000 to keep our business capital inside this policy to help us grow our business. And so the one on the left, we are going to overfund for 5 years. The one in the middle, we're going to overfund for 10 years. And the one on the right, we are going to overfund for life, or we're going to flow as much revenue as possible through the policy on the right. And so let's go down to the actual illustration and look at some numbers. So this one on the left, you can see here under outlay, we are putting in $100,000 for 5 years. The one on the middle, we are putting in $100,000 for 10 years. And the one on the right, we are putting in $100,000 for life. Now, there's some things you want to take into consideration when flowing revenue through these policies is you want to take a long-term approach. And so a lot of times when people first start looking at these policies, they're viewing their premiums as a payment. So we get a question asked frequently because people are just misunderstanding this asset. They say, how long do I have to pay premiums? And you want to shift that mindset and think of premiums as a deposit and not as a payment. You see, the more premiums you pay, the more cash that you actually have in your policies. So we designed these policies roughly the exact same way. And so if we look at this, in year 1, we've got $69,000 available. In the second policy, we've got $69,000 available. And in the third policy, you only have $52,000 available. And it's because the one on the right is built to hold more premiums for a longer period of time. So it's thinking the most long term. Now you give up a little bit of early liquidity to do that, but it's going to allow you to put in more cash over your lifetime. And I'm going to show you why you're going to want that option, especially for your business. And so let's look at the long-term effect that paying additional premium into your policy early on or making bigger deposits early on has on the long-term effect of your policy. Now remember, this is what we call the interest cost. So every time you use a dollar for your business without running it through a policy, you've given up what that dollar could have earned you for the rest of your life. So if we go 20 years down the road, we're over here on the left, we have $1.3 million in cash and almost 3.7 in death benefit. Now the policy in the middle, year 20, we have 1.8 million and 4.8 million of death benefit. So significantly more cash, about $500,000 more, with roughly an additional $350,000 of additional premium that went in for this 5-year time period. So that has already had a tremendous effect on the longer term growth of the policy. And then obviously over here on the right, if you keep flowing more revenue through your policy, 2.6 million, 6.9 million in death benefit. And so premiums equal cash. You want to remember that. Bigger premiums equal bigger cash. Now, if we come down here to the next page, let's assume at 40 years in, this business owner is now 80 years old. He wants to sell the business or transition out of it. On that first policy that he overfunded it for 5 years, he's got 3.5 million and 4.9 in death benefit. The one in the middle where we overfunded it for 10 years, we've got 4.7 million of cash and 6.4 of death benefit. And the one on the right where we continually flowed revenue through that policy, we've got 8.1 million and 11 million in death benefit. So this backs up our point that premium equals cash. You want to think long term. Now, one of the most remarkable ways to look at this policy is on a year-by-year basis. What you're putting in, what is it producing that year? Because of the guaranteed nature of this asset, every year you deposit money in, even if it's the same amount of money, it's going to yield a higher annual cash increase for you because of the compounding of everything that you put in previously. So we're going to pull up a funding illustration, and we're going to look at this from a year-to-year basis so you can look at this as a powerful cash flow tool for your business. All right, we've got a policy pulled up, and this is the same policy that we showed on the right-hand page, funding $100,000 a year for 40 years. So I want you to ask yourself this question. If you've been in business for a while, sales, whatever it is, how many consecutive years in a row has your business or have you personally generated over $100,000? 10 years, 15, 30 years? A lot of people have been making $100,000 a year for quite some time. Now, one of the problems that we've seen in Middle America is we don't save enough money and we don't keep our savings in very efficient saving environments. And this is going to change that paradigm for you. So we know that the internal rate of return on a policy right now is about 3.22%. Now, that's a net number. So if we add in management fees of, let's say, 1% and a 30% tax bracket, you'll now see that if we kept this money in some other liquid safe asset like a savings or checking account, you'd have to earn 5.65% every single year just to match what we're getting on a guaranteed basis inside the policy. So we're going to remove that real quick. And let's look at this from a rate of return view. Now, the first year you put in $100,000, you only have $52,000 available. So this is very similar to how most people view business the first few years. The reason we get into business is because, years 5, 10, 15 are usually much more profitable than the first few years of starting a business. So if you look at your policy kind of like starting a new business, it'll make a lot of sense to you. We got to go through the first few years of capitalizing the policy before we get to the really good years. It's the same reason people go to school. It's the same reason people get into business. Now, if we go 5 years in, we deposit in $100,000. The policy grows from $293 to $398, or $105,000. So you put in $100,000 that year, the same $100,000 that you did the previous 4 years, but this time it grew by $5,032 more than what you put in. If we go to year 10, your policy cash value grows from $864 to $994. Or $129,000 of growth that year, or the annual earnings would have been $29,000 more than what you put in. So I want you to think of that from a cash flow perspective. If you had a business that you knew was guaranteed to be positive cash flow each year, and every year after that, as you can see, the number increases. So if you knew that was guaranteed to happen, how big would you want this business to be? And so as a business owner, this is why I flow as much of my revenue through these policies, because once I get to these years, 5 through 10, 15, 20, every dollar that I'm depositing into my policies is getting me a very high rate of return from a savings perspective. So it actually increases the amount of revenue I have access to invest in marketing, to pay for overhead, to increase profits, except the difference is none of this is taxable. I get to keep all of this privately, and I can still use it for my business, but I don't have to claim any of this, which is a huge advantage, an unseen advantage of having this policy as my primary savings vehicle. So I want you to ask yourself these questions. How many years in a row have you put in $100,000 for your business? What kind of benefit have you been getting from doing that with a bank? Maybe it's time to play the same game the bank's playing and keep our savings where they keep theirs so that you can be much more efficient with your revenue. Now, if we scroll down here to year 40, in the 40th year, let's say you were going to sell your business. Will you deposit in the same $100,000 that was revenue flowing through your business, and it grows an additional $257,000 above what you put in. So this is where we can really use these policies as a passive income stream for the later stages of life. Now, you can also transition at this point to being a business banker. So let's assume you were going to sell the business to some new up-and-coming young individual who's hungry, who wants to grow the business. So you sell them the business. But what I would do is I would put in the contract that, hey, if you're going to buy my business, I want to be the person you come to when you need financing. You see, you have all this cash value or this large banking system here. It's time to start using that like a bank. So if they come to you for the vehicle equipment financing or the x-ray machine that they need for their dental office, whatever it may be, you can be the one financing that. And if you can create $100,000 of revenue from financing the new business owner's equipment, well, you could take that $100,000, run it through your policy that next year, and continue to get these types of returns because of the compounding nature of the policy. So obviously we can see how tremendously beneficial this is for us as business owners to keep more of our capital inside these policies.